Good morning, good afternoon, good evening, ladies and gentlemen. Welcome once again to our episode on the world of investment. So this is just a continuation. We're going to touch today on the start with low cost index funds. So are you ready, ladies and gentlemen? So it is all about index funds investment, and I'll take you through the journey from A to Z. So in the case of low index funds, really it is all about all-in-one investment. So it's just like the mixture of a broad range of stocks and bonds. So first of all, we're going to look at the number one, like what are index funds? So when I say index funds, what do I mean by index funds? Number two, we're going to look at why choose low cost index funds. Number three, it will be like we're going to touch on how to invest in index funds. So it will be like step by step. I'll take you through how to invest in index funds. Number four, it will be like the benefits of starting with index funds. Then number five, we're going to look at the long-term strategy with index funds. After that, I'm going to give a quick summary, just as I usually do at the end of the video, just to sum up everything really, just a summary or conclusion. So are you ready, ladies and gentlemen? So let's begin. Tighten your belt and let's begin. So start with low-cost index funds. We said index funds are simply like all-in-one investments, broad range of stocks and a mixture of stocks and the bonds. So starting your investment journey with low-cost index funds is a smart and accessible way to build wealth over time. So index funds are mutual funds or exchange-traded funds, the ETFs, that aim to replicate or simply imitate the performance of a specific market index, such as the S&P 500. So here's how the ideal really for beginners. Here's why they are ideal for beginners and how to incorporate or include them really into investment strategy. So we're going to begin, ladies and gentlemen. So number one, what are index funds? So we have already seen like they are mutual funds or the ETFs, the exchange traded funds. So definition of index funds, like index funds are designed to track the performance of a market index, which means they include a broad range of stocks or bonds within that index. So it's just an all-in-one investment. For example, so we have to focus on the practicality. I have to keep throwing the example there, like I always do in all the videos. So that an S&P 500 index funds will include shares from the 500 largest publicly traded companies in the US. So it's just a quick example in the US, United States. Passive management, we're still on number one on the index funds. So unlike actively managed funds, index funds don't try to outperform the market. So like unlike stocks, unlike bonds or anything like that, index funds don't try to outperform the market. There's their difference really. So instead, they match the performance of the index they follow. So this passive approach leads to lower management fees and expenses. So this is why they are more ideal. This is why you have to choose them, because of lower fees and expenses as well, expenses or expenditures. A quick example as well. So if the S&P 500 gains 10% in a year, an S&P 500 index funds should also gain around 10% minus any fees. Number two, why choose low-cost index funds? Why do you have to choose them in the first place? So the first advantage to be like the low fees, which you saw above, the expenses and low fees as well. So low fees, one of the biggest advantage of index funds is their low cost. So because they don't require active management, they have low expense ratios compared to actively managed funds. So this is one of their quick benefits or advantages of investing in index funds or low-cost index funds. So this means more of your money stays invested and it can grow over time. So that is what we want really. In the case of investments, like patience as well, it keeps growing over time. A quick example, like why choose low-cost index funds? It would be like if an index fund has an expense ratio of 0.5 or 0.05% or 0.05%, you'll pay just €5. I'm going to use the euro, not dollar or pound, because I live in Europe. So you pay just €5 annually for every 10,000 euros invested, like compared to potentially hundreds of euros for actively managed funds. So too, we're going to look at the diversification, like shared, really spreading investments around. That is the meaning of diversification. So index funds provide instant diversification, so automatic diversification, spreading investment all around. So by investing in one fund, you gain exposure to a wide range of assets, reducing the risk associated with investing in individual stocks or bonds. So stocks, in the case of stocks, they have like high risk and high return. In the case of bonds, lower risk and lower return as well. But the low-cost index funds are more ideal compared to stocks and bonds. So a quick example as well under the diversification, like an S&P 500 index funds gives you exposure to companies across various sectors such as technology, healthcare, and finance, all in one investment. So imagine just invest in one fund and it give you like a wide range really in all the sectors like technology, healthcare, and finance as well. So consistent performance as well. We're still number 2 on why choose the low cost index funds, like consistent performance. So over time, index funds tend to perform well because they attract the overall market. There's a second advantage. So while they cannot beat the market, they also won't underperform drastically. Even though they cannot beat the market, they also cannot underperform, cannot go down really in the case of market downturns. So making them a reliable and a stable choice for long-term investors. So in this case, the low-cost index funds are simply aimed at the long-term index like investors, not the short-term like 2 years or 5 years. So in the long term, we're talking about 10 years plus. So the example of consistent performance, it will be like historically, the S&P 500 has provided average annual returns of around, let's say, 7 to 10%, which you can capture through an S&P 500 index funds. Number 3, we're going to look at how to invest in index funds. So I'm going to take you through the procedures, how to invest in index funds or low-cost index funds. So number 1, it will be like choose the right index. When you want to invest in the index funds, you have to choose the right index. So starting by deciding which index you want to track. So it's all about tracking really, trying to see which one is performing better than the others. So popular choices include the S&P 500, the one which I keep saying in all the videos, the example which I keep drawing. So total cost market index, there's a second one, or international stock indices like the MSCI World Index. So your choice should align with your investment goals, which might be long-term or short-term, and the risk tolerance as well. Once you know yourself, or I've already done the video on the risk tolerance, trying to know yourself for resilience really. So a quick example would be like if you want exposure to the entire US stock markets, United States stock market. So a total stock market index funds like the Vanguard, really, the Vanguard total stock market ETF, the VTI, might be a good option in the case of US stock market. Number 2, we're going to look at the pick a reputable provider, like look or do your own research as well for well-known investment companies that offer low-cost index funds. So some popular providers include the Vanguard, we have the Fidelity, and Charles Schwab as well. SCHWAB Schwab. Yeah. So compare really like expense ratios and performance before making a decisions. So you have to look at the expenses ratios as well before making your final decision. So you have to do your own research as well, trying to track them, which one's performing better. So which one has good performance as well. So a quick example would be like the Vanguard is S&P 500 ETF, the VOO, and Fidelity Zero Total Market Index Fund, which is the FZ or OX, are both excellent choices with very low fees. So you have to look on the fees as well, the case of capital. Number 3, like how to invest in the index funds, to like start small and automate. So start small and try to automate. In the case of automation, it's like putting an automatic payment really in your investment account. So you don't need a large sum of money to start investing in index funds. There's another advantage as well. So many platforms allow you to invest with as little as 50 euros or 100 euros. Like consider setting up like automatic contributions to consistently invest over time as well. So to save you more stress, like daily stress. So it just goes automatically 50 euros or then 100 euros every month. So a quick example of that would be like a setup of a monthly contribution of 100 euros to a chosen index fund to take advantage of euro cost, like averaging and grow your investment steadily. So just leave automatically really 100 euros a month, which will be good. Or you can go for 50 euros, you go for the lower price as well. So number 4, we're going to look at the benefits of starting with index funds. So we want to start with index funds. This is the video is simply based on that because they are low cost. This is why they are more beneficial compared to all those like stocks, bonds, and mutual funds, the ETFs, or the cryptocurrencies. Those are like the higher risk ones. So the benefit of starting with index funds, number 1, we're going to look at their simplicity. So index funds simplify the investment process. It makes it much easier for you to do it, even though you like the experience. So there's no need to pick individual stocks or constantly monitoring the market. You don't need to keep constantly looking at the market or checking if there's a drop or ups and down fluctuations. So you can set it and forget it. You just set it up and forget about it because you have automated already, allowing your money to grow over time with minimal effort. The example of that would be like by investing in index funds like the Vanguard Total Stock Market ETF, the VTI, which we said above. You get exposure to thousands of stocks without needing to manage each one individually. Number 2, it will be like on the low risk as well. So benefits of starting with index funds, low risk as well. They have low risk. So due to their diversification, index funds are generally less risky than individual stocks. They're less risky than individual stocks. So this makes them an excellent choice for conservative or moderate investors. So we have some moderates. So in the case of resiliency really or risk tolerance, conservative investors or those just starting out or those are still newcomers, newbies. So example of that of a low risk, it will be like even if one sector of the market performs poorly, the diversification is in an index fund helps balance out the risk because of diversification, simply like spreading investments all around the places. Instead of just betting on one, you try to bet in 100 more companies or places or 500. So reducing the impact on your overall investment because of diversification. The video we just did last time. So the tax efficiency as well, the benefits of index funds, the tax efficiency. So index funds tended to be more tax efficient than actively managed funds because they have lower turnout rates, like transactions, selling and buying, selling and buying. Those are like the more you sell than buy, the frequently you do it, the higher the turnout rates as well will be. So meaning they sell and buy fewer stocks within the fund. So this reduces or results in fewer tax events. So because they have a fewer buying and sells within the funds, this results in fewer taxable events. So the example of that, it would be like if you invest in an index fund in a taxable account, you may acquire fewer capital gains taxes than with an actively managed mutual fund that frequently buys and sells stocks. So number 5, we're going to look at the long-term strategy with index funds. So this is both for young and older people alike because the time horizon does not matter when it comes to index funds. So the time horizon, like we said in the previous videos, it is all like you are 30 years, you want to retire at 60. So you have 30 years more time gap or time span before you retire. Now imagine at 50 or 55 years, you want to retire at 60. So you have only like 5 years. Or you want to retire 65 years, only like 10 years. So there's a short time span or time horizon. So in the case of young people, you can take more risky stocks. And for in the case of older people, you simply invest in bonds instead of stocks. You try to avoid the high risk and try to go with the lower risk. But the risk is directly proportional to the return as well. So higher risk comes with high return. Low risk comes up with low return as well. So the risk and the reward, you have to keep that in mind. So long-term strategy with index funds, one would be like stay the course. So stay the course. So the key to success with index funds is patience. Try to be patient as well because this is all about long-term, not in short-term. So since they track the market, their value can fluctuate up and down as well, but over the long time, they tend to provide solid returns. So in the short term, the value can fluctuate, going up and down, but in the long time, that tend to provide solid returns. Avoid the temptation to sell during market downturns. Avoid that temptation. So the quick example of that, it would be like during the 2008 financial crisis, which was the market crash. The S&P 500 lost nearly 40% of its values during the 2008 financial crisis. So, however, investors who held onto their index funds, so their portfolios or financial investments recover and grow significantly in the years that followed. So that was a big advantage as well in this case. Then we're still on the number 5, long-term strategy with index funds. Reinvest the dividends. You have to reinvest the dividends. What are dividends? So they're just a share of profits and retained earnings that a company pays out to its shareholders and owners. Those are like the dividends, really. So many index funds pay dividends, which can be reinvested to purchase more shares of the funds. So when the company pays you a dividend, when you're a shareholder or the owner, you can reinvest, or you can try to reinvest to purchase more shares of the fund or in the company as well. So this compound effect, or the compound interest or the compound effect, would simply mean like you interest earning more interest returns. So you're making more money out of interest. So this compound effect helps your investment grow faster over time. The example of that, so I have to clear your misunderstanding, try to explore the imaginative part. So if your index fund pays a 2% dividend, reinvesting that dividend allows you to buy more shares, increasing your total investment value without any additional contributions. So simply contributing using the dividend which the company pays you, and you're using that same dividend, like the 2%, to buy more shares in that company. So we are the shareholders or the owner holding the shares in the company. So periodic review as well, like keep checking. Review is like re-examining, checking over and over. Like while index funds requires less maintenance, it is still important to review portfolio periodically. Ensure that your asset allocation, which simply means like the targeted investing percentage. Let's say you want 60% stocks and 40%, 60% bonds and 40% stocks in the case of older people or the short term. So ensure that your asset allocation aligns with your financial goals and risk tolerance, and make adjustments as needed. So risk tolerance is simply your resilience to know yourself if you are low tolerance, moderate tolerance, or higher risk tolerance. So the example of that, if your portfolio has shifted too heavily into stocks due to market growth, you may need to rebalance by adding more bonds or more asset or other assets, which is just investment. Like more assets can be like mutual funds or the ETFs, the exchange traded funds, to maintain your desired risk level. So you want to maintain really when the stocks goes higher than the required targeted investment, you can try to lower them, try to balance between the stocks and bonds, maybe 60, 40 or 70% stocks, 30% bonds. So the 30% bonds acts as a backup really. So what can you say in conclusion about index funds or low cost index funds? So in this case, they're like ideal for those who don't have any clue about investment, because here diversification is a key. Trying to spread your investment all around the places. Instead of betting all your money in one place, you try to spread them all around. So in summary, ladies and gentlemen, like starting with low cost index funds is an excellent way to begin investing. This is an excellent, the ideal one, the recommended way to begin investing. So index funds like the ETFs, the exchange traded funds, or mutual funds offer simplicity, diversification as well, spreading all around, and lower fees, making them ideal for beginners and seasoned investors alike. So by choosing the right index, investing consistently as well, and staying committed to long-term goals, you can build a solid financial foundation that grows over time. But remember, investing is a marathon. Simply, you don't have to take it really. It's a marathon, not a sprint. So you have to take it slowly. In the case of marathon, you have to run slowly really to keep up, because the distance is too long. So you have to take your time. And index funds are a reliable vehicle to help you reach the finish line. So the index funds are good, ideal for beginners or any seasoned investors. And investing, it is a marathon, not a sprint. You take your time, you try to look around what might be going wrong, all right? So ladies and gentlemen, thank you once again for listening, for watching. And don't forget to like, comment, share the videos as well to your friends or any investors, those who are interested in investing or those who are not interested about investing. You have to let them this video reach them, and maybe they will learn something new today. So thank you again. Don't forget to comment you anything really question about investing. Thanks for watching. Ciao, bye.